the whole game is rigged so that property goes up. So I think you want to be long Australian property.
To think about turning 24,000 into 300 odd $1,000 is like a 15x return, right?
Yeah, it's crazy. You actually start to see the income from that, and it's terrible. Now that I've done it, I think I could do it again. I think a lot of the beliefs is just not knowing what's possible and not knowing how much money's out there in the world and how to create value.
Ladies and gentlemen, we are back for Mingo Property Investing. And in front of me is a man that I've known for some years now. It's changed a lot. The beard has actually gotten better.
Well, yours has too, I reckon.
In recent years. Age has been kind to both of us. Jay Wright, mate, welcome to the podcast.
Thanks, Jack.
Thanks for travelling all the way to Sydney.
That's all right.
You are a Novocastrian.
I am, yep.
That's where we met.
Yep.
Born and bred Novocastrian. I'm an import.
I'm from the Bay originally, actually.
Are you?
Yeah. So, but...
As in like Nelson's Bay?
Yeah, Fingal Bay.
Are you really?
Yeah.
Fuck, there you go. I learned something
went
new.
to school and uni in Newey, so...
Right.
Yeah.
Now, most people would have seen you online. You are you're the ads guy.
Yeah,
if you've got an e-commerce
guy,
business, you're the fucking guy.
Yeah.
Tell us a little bit about your business, because it's a very interesting business. When I met you, you were in agency land.
Oh, was it that long ago?
Yeah, and you were
right.
doing I remember the first thing that I saw, I was like, fuck, I didn't know this guy did this. You did that case study on your Instagram where you did the dad cooler.
Oh, yeah.
I was like, fuck, I had no idea. But when we first met, we met at a cafe. It was like a natural
Moomoo's.
cafe. It was a natural, the natural one in the old bank or whatever?
Yep.
Yeah, and you were looking for your new house at the time.
That's right.
That would have been 5-6 years ago.
It was, yeah. I remember that after that meeting, Marnie and I and my wife just looked at each other and were like, who is this dude wearing shorts? Like, can we really trust this guy to find us our house?
You didn't trust me, but I found the house.
Yeah, we did good in the end. It was, glad we went with our instincts on that. But yeah.
So you've gone from agency land, you set up the business e-commerce equation, and it just went absolutely batshit crazy.
Yeah, we definitely found a gap in the market. So, I think a lot of people were disenfranchised with the agency model.
Mm-hmm.
Most people, there's great agencies out there, don't get me wrong, there's amazing providers, but they'll typically work with the top brands, the best agencies work with the best brands.
Yeah.
If you're an entry-level brand or someone starting up, if you're small or mid-size, you kind of get, average talent, average results.
And even if you're with a good agency, you generally won't get the best talent inside of that agency, right?
Well, that's right. You've got to be the best brand within the best agency to get the best people. So, if you surveyed the market, most people would have had at least one negative experience with an agency. Mm-hmm. Most people have multiple. And I think the market's almost moved on from agencies now. I reckon 80% of brands aren't using an agency to run their media.
It's all in-house?
All in-house. And, I was kind of early on that wave 5 years ago, kind of called it. And we basically help people bring growth and marketing in-house through coaching, curriculum, and a community approach. And it's resonated really well. So, so it's essentially what we created with the e-commerce equation.
It's crazy. I remember just seeing your following on Instagram went from fucking 2 followers to 100,000 followers.
Yeah, it seems like it happened pretty quick.
But, it was nuts, man. It was wild.
Yeah. I actually started a whole new Instagram account and would have been when I started.
And you never used to do content before you got into...
Never.
Because you were pretty undercover. You had
the
your
agency,
businesses.
I had no personal brand whatsoever.
Yeah.
So there was zero personal brand, zero content. It was just referral marketing for that agency.
Yeah.
And then, probably was 2020 I started actually doing content and it was terrible. I was terrified of doing
the dad cooler content was the greatest content I've ever seen. Have you still got that on your Instagram?
Yeah. There's
For anyone who doesn't, you need to watch that. You essentially do a case study of spending X amount of dollars on ads every day.
It was day by day how I scaled a brand.
It was fucking sick.
I think I got it to $20,000 a day, and I just really every day I would just share what had happened and what ads were working and the profit. And
it was very good.
Yeah, I think that was fun. It was really fun.
And then. You had a cool moment recently where someone else thought your business was really cool and they thought, can we scale this thing even more?
Yeah, man. So it must have been 18 months ago now. So it took
fuck, is that long ago?
Yeah, it was January last year.
Wow.
The first tranche, and did got an investor on Glow Capital.
Yeah.
So a kind of growth partner to help us scale further. And so it's been pretty good. It's been a rocket ship since then, but.
And you've always been in business, right? I mean, I think you started as a trader back in the day, like a stock trader, stockbroker.
Yeah. So I got into finance and did a little bit of financial planning. Mm-hmm. Then got a job as a dealer's assistant in Newcastle.
It was for Ord Minnett or something?
Ord Minnett, yeah. And then kind of got offered an associate role there. Went off to London, did some derivatives trading. So I was in sort of finance for 5 or 6 years, and then GFC. wasn't a great time to be in finance. So
So it wasn't like the Wolf of Wall Street?
when I went to London, actually, it was pretty. It was actually a boiler room. I was actually like, yeah, it was not legitimate, but so it was actually pretty similar to Wolf of Wall Street in London. But kind of came back and got into an agency with a friend who was really good at SEO.
Right.
And that's sort of where I got my apprenticeship. Our first client was Hype DC. I don't know if you know the shoe brand.
Just a small shoe brand?
Yeah. So we're doing their SEO, and then they started ranking for like Nike joggers and all these like crazy terms. And they grew like 30% in a couple of months.
Wow.
And
this
so,
would have been like when search was the thing,
yeah,
right?
2012.
Yeah.
Right? So this is like what's that, 13 years ago now. And so because they were e-commerce, we just got all these other e-commerce brands. And that's sort of how I fell into e-commerce, just doing SEO for e-commerce brands.
Right.
And then one of the brands I was doing SEO for was Showpony.
Yeah,
They were Showpony back then.
Wow. I was on a boat the other night with Jane Lou.
Oh, yeah? And so this was like 2013, 2014. And so we were doing her SEO, and she started doing this Facebook ads thing. And it was like right column ads. There was no tracking. There was no pixel back then. And we had their Google Analytics, and we could just see them going ballistic. And we're like, we got to get onto this. So we started doing Facebook ads for some other clients like Camilla, and just rolled it out and started doing Facebook ads.
Which are all like huge, well-known brands now, right?
Yeah. They weren't back then. But
Yeah.
So just sort of fell into it, you know. Yeah, not a real.
Wasn't purposeful.
No, not like a career pathway that I planned out meticulously.
Well, I mean, it's a massive issue for, I mean, not even just e-commerce brands, right? Like any service-based business who runs ads usually gets shafted by an agency because they're like, here's some white labeled ads that we've used for all these other agencies. Here's some like generic copy and a lead capture form that, you know, you generally just get shit leads.
Yeah, it's a hard business model to scale. Yeah, like the done-for-you service model is tricky. You know, it's tricky to do ads at scale.
Yeah.
And so, yeah, a lot of people just, it doesn't work out. But yeah, it's kind of crazy. We're now the largest Meta partner in Australia, I'm pretty sure. We're going to spend $500 million on Meta ads.
It's fucking nuts.
It is nuts, man. It is so
nuts. And considering
nuts.
that's Australian spend, right? The majority of that?
Majority, yeah. We're actually, our fastest growing region is the US now. So we're definitely
Wow.
pushing into the US. I was there this month. I'm coming back next month. So
that 500 million is going to grow really, really quickly.
I think so.
Yeah.
But even in the context of the US, I still think we'd probably be top 10, definitely top 20 partners, even in the US.
Crazy.
Just with that amount of spend.
Give us some context, not the name of the brand, but like you'd see everyone's ad accounts, right? Like what are some of the biggest brands spending on like a daily basis? Just to give people some context. Because we spend between 8 and 10 grand a day at Henderson.
Yeah.
And I think I'm a heavy.
Yeah.
I'm a small fish.
Well, look, say in Australia, right? I think in Australia, there's this inherent cap of the amount you can actually spend.
Mm-hmm.
So typically in Australia, once you get to $30,000 a day, you actually kind of run out of people to show ads to.
Right.
So if you're, say spending, say it's a worst case, $20 CPM.
Yeah.
Costs you $20 to reach 1,000 people. So if you're spending $20,000, you're reaching 1 million people every single day. And, you know, so over a week, you've reached 7 million people. And there's probably not 7 million people in your total addressable market, you know. So every week you're reaching everyone you could possibly reach, probably multiple times. So most people kind of get to 20, 30 grand a day in Australia and spend like $1 million a month and spend. And there seems to be like just a bit of a ceiling of how much you can spend in Australia.
Because then everything starts to blow out, right?
Yeah, you're just getting more impressions in front of the same people. But when you start going to the US, it's sky's the limit. You know,
Right.
So it's, you know, a couple of $100,000 a day isn't uncommon.
That is fucking crazy.
Yeah. I mean, there's also peaks and troughs. Like at Black Friday, you could spend maybe 100, 150 a day in Australia.
Yeah.
When it's like a real peak time. But business as usual in Australia, I reckon 20, 30 grand a day is where most people sort of tap out on Meta.
Right.
But then, you know, you've got Google, TikTok, so you can kind of start to get a bit more on
Where is
channel.
the opportunity now from what you're saying? Like obviously Meta is the standard one that most people use. The Google ads obviously are a thing, but are less relevant now with all that AI shit that comes up before you like.
Yeah.
It's hard now, right?
Honestly, Meta's still the moneymaker for most e-commerce brands.
Yeah.
So we don't tell people where to spend their money.
Yeah.
But we'll probably spend 500 million this year on Meta. We'll spend 100 million on Google. And so we're still a very significant partner for Google.
Yeah.
But that's more just like where people are seeing results. They spend money. It's not like we're telling people to go spend 5 times more on Meta.
What about TikTok? Is there any opportunity there?
TikTok's good. I think in the US it's far greater because you've got the TikTok shop.
Yeah.
TikTok is sort of, you know, teasing that they're going to launch that here in Australia soon. And it is pretty good. The challenge is when you do paid TikTok, it kind of can degrade your organic TikTok.
Right.
So most people are sort of having a siloed organic account and then maybe running a paid account.
Right.
But it's definitely more top of funnel, you know, colder
Mm-hmm.
brand sort of channel for most people.
Interesting.
Unless they've got a very specific product,
Can you tie the pixel together? These are some selfish questions. Like, is there a way that you can use, say, the pixel on TikTok to then track them through Meta when they go to Meta?
Yeah, 100%.
Yeah, right.
Well, it's it's not the same pixel, but basically, so say if you're starting to get to like $20,000 a day in Australia on Meta, often the play is to kind of, do a different objective so you reach a different person. So rather than doing purchase objective, you might go to like a traffic objective.
Mm-hmm.
In that instance, then I'd usually probably shift that budget to like top of funnel TikTok, if that makes sense. But then the people coming in from TikTok, hitting your website, the website's got the meta pixel, and so it's getting those signals for those new people coming through.
So they have to hit your website to be able to then retrack them somewhere else. Yeah,
correct.
Interesting. Yeah. Okay. Enough about ads.
Yeah.
More about property and investing.
Yeah,
you're really the property guy. You're just an undercover property guy. Now, something I found really interesting is you have a history in stocks, derivatives from back in the day, pre-GFC. You might be a bit scarred from the GFC. I'm not sure.
Yep. I did pretty well out of it, to be honest.
Well, you're very pro-property now. I mean, there might be a side of Jay that I don't know about, but like you love real estate.
Yeah, I like real estate. Love shares still, though.
You still love shares?
Yeah, absolutely.
Let's talk about that. Let's talk about your like investment thesis, because you've got a background in share trading.
Yep.
And you're very pro-property. Like, what is the Jay Wright investment thesis or like the investment strategy that you employ? Because we all want to make money in business, but generally we use that money to go and invest for something. Yeah.
I mean, I'm a big fan of like Ray Dalio's idea of having, 8 uncorrelated asset classes.
Yeah.
So I think that, having a good spread as you start to kind of get a bigger portfolio is sensible rather than being, 100% in on one asset class.
Yeah.
So, I'm kind of spread out really and trying to create that diversification in how I'm allocating my money.
Yeah.
But yeah, definitely I think fundamentally in Australia, the system is set up for property to go up. Like if you think of all the tax laws, the immigration laws, basically the whole game is rigged so that property goes up. So I think you want to be long Australian property.
Yeah.
I think if you think of something like America, it's almost the exact same situation, but for the S&P 500. The whole game is rigged. They've got, all their tax laws, all of the investment in the US is rigged so that the S&P 500 goes up. So you probably want to be long the S&P 500, the Magnificent Seven. And so I think like also just, following momentum of markets and how they're structurally established is sensible.
Right.
So yeah, I mean, I think I'm definitely a big fan of Australian property.
And you've been a big fan of Australian property throughout your business career, right? Like when you started in agency land, you were working for someone by the sounds of it, then you started your own show.
Yeah.
Like what was your play to try and grow wealth outside of the business before e-commerce equation and obviously the deal come about?
Yeah, I mean, I got my first property when I was 20, right? So this was actually before being a business owner when I had a job.
Right.
I like washed dishes, worked at an auto spares place, got 16 grand saved.
Right.
And I think...
Is that why you had that little attachment to the auto shop in Newcastle?
Yeah, that's right.
You're like, this takes me back to my roots.
Yeah. And so, that John Howard had the first home buyers grant, and there was a period where they doubled it.
I don't recall, but tell me.
So there was like, I think you got 8 grand from the government.
Right.
So I saved 16 grand, got 8 grand from John Howard, and I bought a $216,000 apartment in Nesca Parade.
Fuck, a lot of our clients are on Nesca.
Nesca's great, man. $216,000 for a 2-bedder.
What's that worth now? Like 800-ish?
Don't know. I don't have it. So,
right.
But yeah, so that was my first property when I was 20. Interest rates were like 9%. And I had to get like a flatmate. I moved into the shitty second bedroom that had rising damp, and I had to rent out the front bedroom to kind of just afford it. I think the mortgage repayment was like $1,600 a month, and it was like a real struggle, man. It was like, so that was my first ever property.
Right.
And I think I sold it maybe 3 years later for $386,000. So I made a solid profit, and I invested that profit coming out of the GFC into like bank shares, and they doubled.
Right.
So it was kind of like my first 300 grand of capital I got from that, from washing dishes at $20 an hour.
Yeah.
Over that first.
Put it into property, sold the property, got the gain, and then with your background in equities.
Yeah.
Then put it into the marketplace.
100%, man.
Right.
So yeah, so that was sort of like my first property experience. So I think it helps when you have a positive first property experience.
Yeah, agreed.
Kind of gets you a little bit hooked into that capital appreciation.
I mean, to think about turning $16,000 or whatever it was, $24,000 with the government grant into $300,000 odd is like a
crazy
15x return, right?
Yeah, it's crazy. It's crazy.
And then how has that developed over time? Like, have you been someone who's gone and bought the owner occupier and continued to upgrade the owner occupier over time, or has it been more of a rent vesting model where you've rented where you wanted to live and then bought investments? Like, how's that look?
It's a bit of a mixed bag. So it hasn't been like a really clearly articulated strategy.
Right.
Like, it's very much been, somewhat having property to meet our personal needs, but also, I think probably for the last few years, the play has been kind of your classic accelerator assets, right? Like buying the inner ring.
You can tell you're a client.
Yeah, the inner ring of Newcastle.
Yeah.
Obviously I have a pretty good income, so I don't really care about yield.
Yeah.
And so, but just buying like really, like the last 2 or 3 I've gotten have been like deceased estates, original cottages. You go and do a cosmetic reno, and you've got 600 or 700 square meters of land, 5 minutes from Newcastle beaches.
Yeah.
They just rent in a second.
With 50 people missing out.
Yeah. So like, so I've sort of built a solid portfolio of those. I think, over the last couple of years, as you start to accumulate so much money that it's superfluous to your needs now and in the future, I think a lot of people that are at that level do use their principal place of residence as a store of value. It's like, land tax exempt, capital gains tax exempt. And so it doesn't really make sense if you are, trying to reach financial independence.
Yeah.
But once you sort of surpass that, most people would really heavily over-index in prestige property for their principal place of residence.
True.
So I've definitely got a solid allocation towards, like
the owner rock.
Owner rock. Yeah.
And because I'm keen to talk about that because I don't think a lot of people get that. I'm lucky because I'm not there yet, but I'm exposed to a lot of people who are there.
Yeah. Do you find the same thing? A lot of people over-index
100%.
at that point?
As soon as there is a big capital moment or liquidity moment, generally the first thing people do is get a fucking sick car and they get the house.
Yeah.
And
what car should I get? No, just joking.
You get a nice car, don't you?
I got a Defender. It's good.
Yeah, that's right.
It's good.
It's like you don't know if you're a billionaire or you're like a surf pro, you know? That's the good thing.
Byron Bay kind of.
Yeah, we see with Frank, he drives the Urus. You're like straight away, you're like, he's rich. So we always say it. It's like someone has a big liquidity moment. They usually go get the big owner occupier home debt free because it is a great store of wealth. Like you said, no CGT and no land tax. But then there's usually surplus capital that generally has to go to work to generate whatever the outcome is, which is usually cash flow.
Yeah.
And it sounds like that was what happened with you, right? Like you had, you still had a nice home, or you were building a nice home.
Yeah. Yeah, so I've definitely had a pretty good home.
Yeah.
But Newcastle's like maybe 14 beachfront blocks.
Yeah.
So it's very interesting. Like if you think of Newcastle, if you think of Sydney, all of Sydney Harbour, all the Sydney beaches, even within the Sydney beaches, if you think of something like Bronte or Tamarama, you've got these deep kind of coves, and you've got multiple streets that almost have this beach view. You've got all the northern beaches with like just literally hundreds of beachfront properties through the harbours and all the beaches. And all these homes are worth like tens of millions basically in Sydney. And if you think of Newcastle, it's the 6th largest economy in Australia. It's got 1.6 million people in the greater, Newcastle, Lake Macquarie, Hunter area. Yeah. And there's 14 beachfront properties. And for me, I just think it's a no-brainer. The amount of people moving there, the amount of money that's in that economy, the amount of development, there's thousands of units going up.
There's a lot of cash there.
A lot of cash, and all the cash just rolls up, So for me, I think that's going to like have outpaced returns. Obviously, I'm probably never going to realize those, but you do start planning beyond, you start thinking about future generations and what they're going to have.
The kids.
So, yeah.
Kids are pumped you're thinking about it.
I know. So, so I think like it's a really solid investment thesis is like that prestige property. I love Newcastle. Like I think.
Yeah, that's another thing. We're big pro Newcastlers, but I'm only a pro Novocastrian because I just happened to move up there for my girlfriend many years ago, and I was like, fuck, I've never heard about this place. This is crazy. Yeah. You spent a lot of time there. Yeah. Like your whole life, essentially. You were born in the baby. You spent a lot of time in Newcastle. Like, how have you seen that marketplace change over 20, 25 years of probably being conscious of it?
Yeah, I mean, it's definitely gentrifying.
Yeah.
It's really mixed, I think there's pockets. And I think it'd be really challenging to do Newcastle unless you lived in Newcastle or had an expert who could tell you like where you should go because from street to street, it can be very different. Yeah. So it's definitely gentrifying. I think like, the Merriweather bubble is like analogous to the eastern suburbs, in my opinion.
It's literally. I would actually be interested to know in Merewether, like, there's a lot of wealth there.
Yeah.
Like, you can tell they've got nice houses, but like the houses probably aren't relative to the wealth of the people.
Yeah, I'd agree with that.
In Sydney, like, if you live in Vaucluse in certain streets and your house is worth $30 million, you sort of get an understanding of like the wealth that person has.
Yeah.
In Newcastle, you could be in like a $5, $6, $7 million house, which in the grand scheme of things isn't all that much.
Yeah.
In comparison to what you can buy.
Totally.
But that person may be worth, 100x that.
Totally. They're the surgeons, the anaesthetists.
Yeah.
Like, they're just
small business owners, all the people.
100%.
Crazy.
100%.
Dude, I feel like every fucking second person in Newcastle has like run and owned McDonald's franchises.
It seems that way. Lot of big construction companies.
Yeah, mining businesses.
Yeah, like or even like a plumber with 100 vans. There's some real wealth there. You know? So, but yeah, it's still got a good community feel. Like, I think it's still like, you're never more than 2 degrees of separation from anyone. It's not very transient. Like, there's no tourism there. Like, no one ever comes to Newcastle.
It's true.
And it's got this really good community feel. Like, kids ride their bikes in the streets. Like, you kind of bump into someone every time you're at the shops.
Yeah.
And so
no traffic.
No traffic. You can get anywhere in 5 minutes. So I was in Bronte, was in Maroubra, and just didn't. I thought Newcastle would be a better upbringing for the kids. So
yeah, I was going to ask that. Like, was there ever a thought when you had the capital moment where you're like, oh, maybe we could go and be the...
Yeah, we could be anywhere, right?
Yeah.
But like, I love Newcastle. Yeah. So like, that's definitely where I want to be. Like, I love Sydney. Like, I'm here every week. But, which when you think about what you want the upbringing of your kids to be, and, I definitely think like it's more of a low-key Newcastle upbringing versus sort of like the hustle bustle of the city.
Sydney, yeah. And there's good schools there as well.
There's okay schools.
Grammar's good, isn't it?
Yeah, it's not like the Sydney schools.
I'm commenting on schools like I fucking got kids.
You got no clue. The schools are okay.
The schools look good as I drive past.
The schools are okay. It's definitely like, there's enough, like in Sydney you got like, 5 great Japanese restaurants you can go to. In Newcastle is 1. There's 2 shit ones.
Is there a great Japanese? What is the great Japanese? There you go. Never been there.
Yeah. But like there's enough.
You ever thought about starting a blog, like an Overcastrian blog?
A food blog?
Like, hey guys, just Jay here, tested this.
If anyone wants any Newcastle recommendations, just hit me up. Yeah.
Another thing I'm curious around, and I've asked a few different people on the podcast this question, is like, most people invest in property because they want to get to a position where they have financial independence, or they want to have this wealth where they're like, they don't have to worry about money anymore.
Yeah.
You're in that position now through just sheer hard work and intelligence. What was the feeling? And I actually briefly remember having a conversation. I think you said something on the lines of like, my goal always through life was to get to financial independence.
Yeah, very focused on that.
Yeah, like that was the goal, right? And then all of a sudden one day it happened.
Yeah.
What changed in terms of mindset and like how you thought about day-to-day life and money and all that type of stuff versus, say, 12 months prior where you maybe weren't in that position?
Yeah, I mean, it's quite disorientating. Like, if you've got a compass pointing north and you're just charging towards north for 15 years and then you kind of like hit the North Pole and the compass just starts spinning in all directions.
That's such a good analogy.
It's pretty, it is quite disorientating because you kind of orientate your whole life around one metric, one outcome. And you kind of, when you get that, it can be like a little bit of a head fuck to try and deal with it. But, I think you just acclimatize to stuff. So it's been 18 months now.
Yeah.
And it's almost like you take on a whole nother role. It's almost like the CEO of this portfolio. Yeah. And a lot goes into that. You've got tax structuring, you've got acquisition of assets, you've got asset allocation, risk mitigation. Like, there's a bunch of stuff and it's always ongoing. Yeah. So it's almost just stepping into that role a little bit. But I think that the thing that's probably changed the most is you've just got no excuses anymore. Like, often you would sacrifice like consciously or subconsciously like time to do things you need to do for yourself or for the family, and you could make those trades.
Because you've got like, I've got to go do this for work.
Correct. Or, like I've got this bigger vision, this is going to pay off. So you might go away or you might like skip a workout or whatever, like eat on the road instead of healthy. And then you kind of don't have that excuse anymore. So you're like, if you're not optimal in all these other areas, you're like, well, what are you doing? Why am I doing this? So it does. I definitely think it makes you reprioritize stuff, and I definitely think it just realigns what you actually are doing. So, I'm doing a lot more travel. I'm probably working a little bit less. I've got a CEO on board who's running a lot of the day-to-day.
Yeah.
And I'm sort of working on the stuff that I think I can have impact in the business, but also not necessarily be like super heavy operationally.
Yeah.
So it has changed quite a lot. It's quite a relief. I don't know how other people think about it, but it's just a sense of like peace and relief and also like just excited for the next, like I'm still, heavily involved in the business.
Yeah.
Like, I've sold down a bit, but not
still
everything.
majority?
Not quite.
Or very close to.
Yeah. Private equity deals usually take control. But like I'm still like basically, leading the strategy and very involved day to day.
I mean, it's still your face, right?
100%. I'm still all
You're
in.
still in the DMs.
Yeah.
Hey man, you love the content?
So, but it's also, there's no stress attached to that.
Yeah.
It's not like your whole net worth is riding on this one asset. It is a peaceful place to be.
What about like beliefs? Is there like beliefs that have changed now that like maybe you had around work, business, money that have now changed and like, oh fuck, it's funny I used to think that.
Yeah, I think it's just, now that I've done it, I think I could do it again like so easy. And just, I think a lot of the beliefs is just not knowing what's possible and not knowing like how much money's out there in the world and how to create value and the huge amount of beliefs, I think back to my first business, right? I toiled for like, say 6 years. And I think I got that thing up to like, maybe like 500 or 600,000 profit. But that was like recorded profit. Like half of that profit was in bloody account receivables because we had shit collections.
Yeah.
So, and then I sold that business and it took me 5 years to get it there. And then this thing, it took 3 years to get to like 8 figures in profit. You know what I mean? And it's kind of like still going ballistic.
Yeah.
And so like just the speed of getting to places once you've done it, I think a lot of people just play really small and they don't believe what's possible because they've never been there.
Yeah.
And that's why I really like getting involved with Glow because it's almost like access to the next level of business, which is one of the outcomes that I wanted.
Yeah.
Was how do they play business at that level? Like what does a multi-9-figure valuation business look like? How does it behave? What are the governances around that? Like who's the team? How do you acquire talent? Who are you selling it to? All these kinds of questions. So just having a seat at that table has been really great, and I do enjoy.
What's one of the biggest unlocks that outside of I guess the business structure and what they've done to the business? Like, what's one of the unlocks that I guess has happened since Glow have come in? I mean, you're in the US now, which you weren't.
US is big, yeah. I mean, look, what they're doing is they're trying to create value, and these businesses are very valuable, and I think they can be more valuable if they're orientated in a certain direction. So the difference between a 10 EBIT multiple and a 15 EBIT multiple is 50%.
Yeah.
And that's got nothing to do with how I'm operating the business, our profitability, anything like that. It's basically the positioning of the business and the attractiveness to different buyers and suitors.
Yeah.
So, if you introduce technology, if you're in different markets with a larger total addressable market size, all these things can add significant value to the business without really doing much, And so these guys are kind of inventing hundreds of millions of dollars in enterprise value with a couple of suggestions. And obviously thousands of hours of work can go and happen to make those a reality. But it's just sort of seeing that, or even just like seeing some of these other transactions, like, Quadlock, which was one of Justin Ryan's investments.
That's like the thing with your phone, yeah?
Yeah. Just sold for $500 million, right? But
that's crazy.
But I spoke to Rob last week. He started it in 2011. And I think in 2020, maybe 2020, he sold a chunk to Justin Ryan. And they've kind of 5x the value in 4 years. And from when Justin Ryan invested to that subsequent sale. And it's just crazy to kind of like be like hear the inside of those stories and just like, and that's now the normal now. So it's sort of like you just reset all of your expectations.
That was going to be another question. Like, you fucking made the rich list this year. You were on there. You beat Frank, which is great. Yeah. Shout out to Frank.
It's not a competition, but
it's not a competition. It is. It's like an internal that's how big is it?
Yeah. When are you going to get on that list?
It's coming. I got too much debt.
It's half, I don't know, like half of those valuations, unless you've been marked to market and someone has actually paid money for your business.
Yeah.
Like it's pretty, I don't know, some of those valuations
From what
could be dubious.
From what I heard from mutual friends, it's like they just ask you, "Hey, what do you got?" And you're like, "Oh, yeah, I got this, and this." And
Yeah,
just
there's some check, and they talk to your accountant, but it's more the business valuations, right?
Yeah.
Like if you've got a business doing, 100 million turnover, 10 million profit, you could value that business at 30 million, 3 times profit, or 6 times profit, 60 million, or you could value it at like 4 times
turnover.
Revenue, 400 million. And so unless someone's actually paid money for that asset,
it's hard to say.
It's hard to say.
Yeah.
And so like I think there's this whole, there was the natty or not movement where a bunch of like fitness influencers were exposed for taking steroids and saying that they got there eating, clean and exercising.
Yeah.
I think there's going to be a bit of a business influencer shakeout where a lot of these kind of like fake natties get exposed
for not having,
for inflating or embellishing for the purpose of self-promotion. But
there was going to be a question, like now you are in the circles, right? Like you're around, you went from having that business to a 500,000 profit local business, you knew some cool businesses by the sounds of it, but it's not like you were the guy.
No.
Where now like the tables would have turned, right? Like it's, if you want to get into a door, it's one phone call, and I'm assuming a lot more people want to talk to you now than what they did previously.
Yeah.
How has that changed things? And the opportunities that now opens up. Like I'm assuming when people see you sold a business, you get called a lot. Like, hey man, I got this great idea.
The rich list definitely puts you on the radar. I think even up until last year it was pretty low key. Even when the transaction happened,
right?
It's like an article in Street Talk for a day and then it's over. But like I think that list really did popularize me. But it's weird because I've just got this double life. Like I just live in Newcastle. I like drive to Honeysuckle, work a little bit, and go to school. No one knows me, And then, but then, everyone wants to like be on the podcast or hang out, and it's sort of like this double life where I come to Sydney and the whole team's there. And so
I don't feel like I like you now more because you're more rich. I was like, I was there. I was trying to win your business when you were poor, or more poor.
Yeah. But no, I don't know. Nothing's really changed. I don't think my identity's changed personally.
But like, what about opportunities? Because like, I know for myself personally, the bigger, like I just joined YPO. So like all of a sudden I'm fucking sitting in rooms with people. I'm like, oh yeah, what do you do? And they're like, oh yeah, family business is this, or like I founded this. And I'm like, holy fuck. Like I remember being a kid looking at those brands on like the shelves and stuff.
Yeah.
And like I can imagine over a period of time, like all of a sudden that then becomes a norm. Like you said, a guy that just sold a company for $500 million. Like you think 10 years ago, $500 million wouldn't have even fucking registered on
register that amount of money. Yeah, 10 years ago.
So is that like that change anything? Or it's just like you said, you acclimatise to it and you get on with life.
Acclimatise to it, and it's just you definitely start hanging out with a different circle of people.
Yeah.
But my day to day, I'm kind of hanging out with like, kids, school parents, and like it's like
from Marnie's Instagram, it's like you're always at the beach. Kids are surfing. Kids surf a lot.
I do surf a lot. So yeah, I don't know. Like it's a lot more opportunities present themselves to you. I think probably the biggest thing that changes is like as your business gets bigger, you realize it's not about ideas; it's about recruitment. And so probably the biggest thing that's changed having a profile is that people are more receptive to talking to you about roles.
Yeah.
And I think like from the acquisition of talent perspective, it's been really good. We also introduced an employee share option plan, and which is awesome. Like we got like more than a dozen people in the business now own it, which is awesome. I think we'll probably make like there's going to be a lot of millionaires that are made from e-commerce equation that work there. So when you have like a business that's got a valuation and you have an employee share option plan and you have a founder with a bit of a profile, like it's way more compelling than, just some random faceless corporate or just like a small business that no one knows. So that's probably been the best thing. It's just the level of talent that we've got access to now.
Interesting. And talent obviously makes the business, right?
Totally. And just who you can pick up the phone to solve problems. Like, if you want an introduction, call 5 or 6 people, you'll have an introduction. Or if you've got to solve a problem, you can always ask someone and they've probably solved a problem at that scale.
Yeah.
Because a lot of these problems are scale problems. So we want to you don't want to hire one person, you want to build a department. Or you want to hire a CMO who'll build a department. Yeah. And so, so it's just, people that are peers and have worked on what you need to work on. I think access to that's been amazing.
And being able to speak to people who have been there and done it is like the biggest unlock, right? Because you don't have to try and work it out yourself. And like
100%. Like the amount of people that I asked, what did you do with your money? Like, because you got to figure it out.
Yeah.
And
what do they say? I spoke to Jack. He was a great guy.
Yeah, I mean, you've got some really good insights, but you ask a bunch of people that are way further along or have been where you are, what they do with their money, and you kind of just see the commonalities.
Yeah.
Like, do people use advisors or don't they? Or,
what are some of these things? Come on, like, spill the beans.
Well, I mean,
do most people use advisors?
It's a bit of a mix. It's 50-50.
Yeah.
It's kind of on the fence. It depends whether you have an appetite for doing it yourself.
Yeah.
Which I do. So I didn't use an advisor. Which is a little bit scary, but
you're a smart guy there.
But it's more like, just getting a really good tax lawyer for structuring and stuff like that in place.
Yeah.
Like that's more the advice that I'm looking for. So, but I mean, it's
what about kids? You got kids?
Yeah, 3 kids.
I've spoken to quite a lot of wealthy clients and friends who one of their biggest concerns is that they don't want to grow their kids up. You grew up in a normal household.
Yeah.
Your kids will grow up in a wealthy household.
Yeah.
And like you're making sure their perception of the world is not diluted. Have you had those thoughts?
I have, man. I think we're pretty grounded. Like we do a lot of travel, and we all fly at the front of a plane. We do some like bougie stuff.
Yeah.
But I don't think that. I mean, it's tricky when you grow up. I grew up in a normal middle class, family. We went on holidays once or twice a year to Gold Coast. You know what I mean?
The entrance.
So, but like we took the kids skiing in Zermatt. We went to Paris Disneyland for 5 days, for Christmas. So we're doing different stuff.
Yeah.
But I don't think that they're any less grounded. It's just, and I want that's why I worked hard so I can experience and do cool stuff. And we're a family unit, so we're all going together. You know? And so I think if I ever started to see that there was a level of entitlement or ego, then I'd probably deal with that. But they're pretty grounded, and I think a lot of that just comes from being present. And most of our day to day is pretty normal. Like we're not rolling around in Lambos or anything like that. So, but a lot of what is probably over and above what would be considered normal is like travel and experiences, and we kind of over index on that.
Yeah.
And I mean, it's not that different going skiing in Thredbo than Zermatt from the kids' perspective.
No,
they're just at the snow. So, so I'm keeping an eye on it. But at the same time, I'm like, imagine if you grew up and you had like, if you're in school and your first car was just gangster, how good life would have been, So I'm kind of like, I don't know. We'll strike a balance, but
it's true.
I'll figure it out.
The reason I think, like for you and I, it would have been gangster is because you can't get it.
Yeah, that's right.
It's like when you get it, you're like, oh, it's not that gangster.
That's right. So I don't know. I'm still on the fence, but we'll toe the line.
It's interesting. Yeah. I hear that stuff a lot. Like the biggest concern with most people that come into this big moment of liquidity is like, oh, fuck, I don't want my kids to be. Like fucking Frank flew economy the other day.
Yeah, that's wild.
Like,
that is wild. I don't know.
Oh, he didn't fly economy home though, don't worry.
Yeah, that is wild. I don't know if I'd do that.
What about, just before we wrap, because I know you're a busy man, the way that you invested previous to exiting, the way that you invest now and will continue to invest in the future as you get more liquidity moments, like the difference from what I've understood from you is like before you have this big liquidity moment, you're investing for capital because you're like, oh, I want more capital, right? You grew your first 16,000 to 300, 300 or whatever it was before it. Now you've got this huge amount of capital. Yeah. You probably don't need to grow that capital all that much, and now cash flow becomes more important, right?
Yeah, 100%. Like simplification and cash flow. So I think the cash flow thing is interesting, man. So when I sold my agency, I had 3 properties, and we moved into one. And I had a place in Tyres Hill, a place in Mayfield, and a place in Maroubra. And when I got that check from selling the business, it was like a low 7-figure check. It wasn't life changing, but basically paid off all the debt. Yeah. And sort of wanted to just decompress for a little bit and work on some e-commerce projects and stuff like that. So I had this experience probably when I was like 30 and 29 or 30, that like, theoretically I had $2 million net of assets all in Australian residential property. And I was like, sweet, I'm like going to chill. And then you actually start to like see the income from that, and it's terrible. You know what I mean? Like you're getting, $460 a week on a $1 million asset in Mayfield. And it was probably about 800 grand back then or something, right? Yeah. But then you've got, rates, you've got water, you've got management fees.
We love land tax.
Yeah, so you're kind of getting like, 1% net on residential property in Newcastle. I know you guys can ninja stuff a lot better than that.
It's still not that dramatically different, right?
It's not that dramatically different. No. So, so then I think of Australian residential property as a growth asset, not an income asset. Probably one of the biggest mistakes I made was not pivoting to commercial sooner. So I've got a couple of commercial properties, and those things are epic, in terms of cash flow.
Yeah.
So, yeah, I mean, like, the majority of my wealth is still tied up in private equity with my trading entity.
Yeah.
And so the stuff, and it's still cash flowing like crazy, that thing. So,
because the business is still generating income, right?
Yeah. 100%.
Yeah.
And so, but you kind of do want to be in a position where, if we need to make significant investments, we need to do an acquisition and the dividends stopped, you'd kind of still want to be in a position where you're pretty solid.
Yeah.
So have invested for cash flow. So basically, the big differences are basically debt-free, right? So basically debt-free. And I think if you're doing 100% cash deals, like Australian residential property isn't great. Like
it's not great
works.
At all.
The reason that it's better than shares is because you can leverage it, right? You can leverage it, 5 to 1. And the return on your money invested is usually great compared to shares. But when you're like comparing it on a if you're zero
debt,
no
leverage,
debt,
yeah.
Like even commercial property, right? You look at a lot of deals. Like I nearly did this deal on this place, this garage, right? Like
you didn't do it.
I was an underbidder, so I bid 1.7, which was a 5% yield.
Yeah.
And then someone from Wright bid 1.71, and I just tapped out because, like, I could buy BWP, Bunnings Warehouse Property Trust. That's a 5% yield, right?
Yeah.
And you own like 50 Bunnings warehouses. There's no better tenant. There's no risk that, like that place had tanks in there. There's contamination risk from the tanks.
Yeah. There's
like vacancy risk. There's all these risks with that property.
And all the costs that come with it, right? So it was 5% net yield, but then you got your expenses on top of that, right? Your CapEx, you've got your land tax.
Right.
Where with like Bunnings, you wouldn't have that.
Totally, right?
Yeah.
So like when you're investing on like a non-debt funded basis, I think you do start to make different decisions and you start to like think about things differently because a lot of the benefits of investing in property come from leveraging up to 60% for commercial or 80% for resi and just letting leverage kind of, obviously there's some risk associated with that, but it levels up the returns.
Yeah.
And so just kind of like investing in a non-debt way is very different, I think, and it starts to think about things differently. But I probably went too far down the residential property route, and like I'm like, in hindsight, a way better play would have been to, like we got an office in Sydney. It's like 20 grand a month rent.
Yeah.
3 years ago, I probably should have just gone and bought that premises or something like it.
Yeah.
And then I'd be 2/3 through paying. I'd be a third through paying it off.
Yeah.
You can, we did a like multi-6-figure fit out. So you've like enriched the value of that asset for the landlord. That could have been me.
Yeah.
And so I did that twice with places in Newcastle, our offices there, and they've done incredibly well. So I think probably in hindsight, once I started hitting my land tax thresholds, I in hindsight probably would have pivoted to, especially with the amount of capital and cash flow I had just from like the operations of the business before I had my liquidity event.
Yeah.
I probably would have pivoted earlier. Like
interesting.
And into commercial. Just land tax is such a drag on yield, man.
Huge.
Like once you start to pay 1.6% on land tax.
Well, you assume like even if you're debt free, right? So you get a 5% yield minus 1.6, you're down into the mid threes.
Yeah.
Minus say 1.5% for council rates.
Correct.
You are 1.5%, 2% net.
And it's just really hard to. You need just a giant portfolio to live on that. So
yeah.
I mean, like that's probably one thing I would have done differently. I think getting better tax planning advice up front. Like I think maybe went a little bit too heavy into personal name. Probably should have shifted a bit more sooner. It's good for negative gearing and stuff, but I don't know. Like I think that's probably the biggest things.
Well, that's good because it aligns with what we talk about. It's like
Does it? That's
good. we talk about the 5 stages of investing, right? Like when you've got no money or assets, it's all about accumulation. So using leverage to your advantage.
Definitely.
And then as you get towards the back end of your journey, whether it's for someone like you where you've all of a sudden had a liquidity moment, or it's for the traditional punter out there, which is you just go through life and you have more capital when you get to the end of your life.
Yeah.
Then it's really about transitioning out of resi into commercial or something like you said. Like when I always say on podcasts or in content, you should invest in other asset classes. I'm not qualified to tell people what to invest in.
Yeah.
But you said a great example. It's like you can invest indirectly through property through something like a trust, like a REIT. So if you use Bunnings Warehouse, they have all of their assets, which is a publicly traded REIT, and you can invest in that, which is 100% liquid. You can sell out at any moment.
Yeah, sell a little bit. You can, 100%.
And you're getting your 5 or 6% as a yield.
Yeah.
And it's like you said, the most recession-proof asset ever, right? It's like Bunnings ain't going anywhere. Everyone needs to get their Ryobi cordless drills.
100%. Yeah. What else has changed? I think just different asset classes. You know, so like there's some. Once you become a sophisticated investor, there's some juicy stuff out there. You do need to go through some investment advisors, like say for private credit and stuff like that, which I'm just starting to look into.
What's the returns you're getting on private credit now? Like 11-ish%?
Once they take their pound of flesh and stuff, it depends how risky you want to be. So you probably spread it out a little bit, but it looks like you get like 7 to 9%, which is pretty solid,
pretty good, yeah.
But yeah, man, I think like that's just. I think I also have, with the benefit of hindsight, like if you're a business owner, the most leverage you have is in your business.
Yeah.
And just getting that sucker to like print more cash. Like I think I've always been conscious through my investment journey of like how much time am I focused on spending my money versus making it.
Yeah.
And spending it is like, planning trips. It's like bloody renovating houses when I should be like focusing on my business. And so like I've just really consciously tried to like spend as much time as possible just building my business because that's the biggest capital appreciation you can possibly have.
100%.
Or even if you don't get a liquidity event, just the cash flow from it, you'll never do anything comparable. Like if you that's the driver for all the wealth creation outside of it too, right? It's like without a really solid business or a really solid income from a job, there's nothing you're doing outside of it which can make a material impact. Yeah, and when you've got a business, like that's the risk asset.
Yeah.
So with your other stuff, you kind of just want it to be pretty bulletproof. So a lot of what I've done has been like just super safe, safe as houses kind of investment stuff.
Legit.
Yeah, safe as houses. Yeah.
As we wrap, what's for you coming out of agency into a new business model, like the unlock? You were like, what the fuck? How didn't I discover this like 20 years ago?
Yeah.
What is that thing, or what is that one thing that now you learnt from that transition? Like agency, you're still solving a problem. Maybe the problem wasn't as big as the problem you solved with e-commerce equation.
Yeah.
What's the question I'm trying to ask? The question I'm trying to ask is like for someone who's in business now, I assume me, we're solving a problem. We're making good money.
Yeah.
But like, how do we find that thing like you did with e-commerce equation where you're sort of still in the same world?
Yeah.
But the problem you solve for the end consumer or your customer is so much larger, which means the returns you get on your metric of time input is also so much larger.
Yeah, I think it's like, you're right. Like we're doing the exact same thing as an agency.
Yeah.
We're solving the same problem, right? Which is people want to scale their e-commerce businesses.
Yeah.
And I think that the realization that I've had is that the opportunity vehicle was the constraint. So I'm always like, every day I wake up and I think, what's the bottleneck in the business? What's the constraint? And I'm constantly kind of surveying anyone that I can to get an understanding of their businesses so I can calibrate my business to theirs, especially the same business model. So at a certain point, you kind of realize, well, the limitation of my business is the business model. Like, trying to hire people for as cheap as I can and charge them out for as much as I possibly can is leading to dissatisfaction with for the client and burnout for the team member. Like that agency model is fundamentally flawed.
Yeah.
Sure, you can scale it to like low 7 figures. Some people have scaled it to 8 figures. But the only way you really do that is by going upstream with clients. It's hard to scale the number of clients you have in an agency.
Yeah.
So the realization was the business model was what was flawed. And so, I think it's two things in that. One is just like the relentless focus on understanding what the constraint is in your business, calibrating yourself to others so you can get more input.
Yeah.
And then that shift was really just the opportunity vehicle. You can still deliver, I'm delivering growth through ads in a done for you model. This is in a done with you model, in a leveraged coaching model where the past constraint of having enough quality talent for cheap enough is now removed. And that just unlocked 50x growth.
Because the customer, like the TAM would be the same, right? Like,
TAM's the same.
Like you serving the same customers in a different way.
Yeah. Yeah. So it's just, I don't know.
Interesting.
It's And I think about that now, but we've got an incredible business model. I do think, I don't know if the opportunity model here isn't the issue. It's
I mean, especially because it's a global, right? Like to run ads in the US is the same running ads in Australia, is it not?
100%. Yeah.
Fuck yeah. And if you can run ads in America, why can't you run ads in India?
Yeah. Where's your mind go when I said that? I could see the wheels turning. You're like, how do I?
Well, I just know that like our it's a similar model, right? Like we can only help so many people to a certain quality.
Yeah.
But before it gets too big. So like the avenue that I've personally chosen is instead of trying to go for more and more and more people, it's to serve the same amount of people but charge them more and more and more, right? So you're serving a higher affluence client.
Yeah, better clients.
They pay more money to you. You can add more value because they have more money to work with. So that's what's allowed us to scale really quickly up to this point. But again, like you get to a point where you're like, we can't really charge more.
Yes. Yeah.
Like we can only increase our fees to a certain point before it just becomes unfeasible.
Yeah.
And we're thinking about all these other ancillaries to our business, like asset management, like finance, like the building company.
Yeah.
But I think there's an unlock. There's a guy by the name of Graham Holm. I don't know if you've seen him before. He's got Infinity Wealth.
Okay.
Fucking he cracked it, man. Like I think it'd be doing north of $100 million now, that business.
What's his model?
His model, genius. His front end product is he helps people pay their mortgage off in under 10 years.
Okay. Which
is using he's a mortgage broker by trade, set up this system. It's essentially using an offset account. He's marketed it as this unlimited redraw thing. But it's a problem.
Good reframe.
That everyone has.
Yeah.
If you have a mortgage, you want to pay that fucking thing off as fast as you can. And most
100%.
people don't know how to do that.
Yeah.
So we teach people how to pay it off. So it's like a done with you model. It's education on the front end, essentially. It's like $1,500. Then it goes into like an $8,000 done with you sort of program thing. That obviously captures finance. But then on the back end, which is where he makes, I would probably say 60% of his revenue, if I would assume. It's all then he puts people into like off the plan apartments and stuff like that.
Oh, wow.
Which is like, because you
mass kickbacks.
It's like 5, 6, 7%, whatever it is. And but because he's built trust at the front end, fully monetize them and they'd be net neutral on the front end.
Yeah.
Paid down debt, increased equity position. Now it's time to invest in property, and then obviously
wow, that's interesting.
The off the plan thing. But
that's crazy.
The front end offer is so good because it appeals to every single person who has a home in Australia.
Yeah.
We don't have that.
No delivery debt because it's just a.
That's right.
That's interesting.
It's the same shit where we don't have that at the moment. It's like you see us and like to work with us, you have to pay us $35,000.
Yeah.
So we don't have that like thing at the front, which we can serve a lot more people.
Interesting.
Anyway, that's where I'm stuck. Mate, that was very good.
Thanks, man. It's good.
Thank you for coming down. Thank you for sharing.
Anytime, man.
And if anyone has an e-commerce business,
thanks for helping me buy like half my houses as well.
Thanks, bro. Appreciate that. Clip that. That's a testimonial right there. Jay Wright says, thanks for helping me buy my houses. All right. This is general advice and does not take into consideration your objectives, situation, or needs. You should consider if this advice is suitable to you or your circumstances, and please read any applicable PDFs beforehand. This is a Henderson podcast production.